Ciao Davide, welcome to the check-in.
Ciao, come stai?
Tutto bene, tutto bene.
Ah,
So, Daphne 17, Davide Marcotti, you've been on before to do a solo episode. Have you also been back apart from that, or have we only?
just as a solo episode. Now, this is my second time on the show. Very exciting.
Well, no one's more excited than us. This is a 20-minute video, approximately, and most of the questions are sort of randomly generated. So it's not a conversation that flows from A to B to C. But we'll start off, Davide, by asking about your current view on the state of the market. You'll likely want to touch on Silicon Valley Bank and its bailout that isn't a bailout, the latest CPI figures, and any likely Fed action you foresee this month.
All right. Yeah, that's a good question. Let's break it down into three digestible chunks. So the first one is where I see the market, if I'm not mistaken, and talk about the Silicon Valley Bank fiasco, correct? So Silicon Valley Bank was a good example of the repercussions that very few people could foresee when it comes to rate hikes, right? So just to give the listeners some context there, and I've recently just published an article on eToro about the Silicon Valley fiasco, but basically these guys were thriving, okay? Over the past couple of years, their deposits were doubling year on year, and they had a very good problem on hand, which is how do we deploy this capital? Right? Because when you deposit money at a bank in a cash account, right? And I do banking as my day job, right? When you deposit money in a cash account, that's an expense for the bank, right? Because they need to service your cash accounts, right? You're going to have questions, and therefore we're going to need staff to answer your questions. You're going to make transactions, and sometimes banks do not charge for transactions. So really what it comes down to is that your deposits are a cost for the bank, right? So then in order to mitigate those costs and make a buck on your money, they need to invest their money, right? So how do they do it? Normally banks, their core business is lending, right? So they borrow money from you at a percentage, right? So the interest rate that they give you on your deposits, plus the operating expenses that goes into the cost side of things, right? And then they lend it out, right? So they're money market makers, basically, right? So they're money markets. They borrow money from retail or from institutions, for companies, from startups, and then they lend them out, right? And then they use fractionalized banking, but that's another story, right? So basically they go on leverage, right? Okay, so then they needed to find a way to make a buck on those deposits, right? So then they went into the market and they were like, all right, well, who wants a loan, right? Because that's what banks do. They give out loans, right? But what is their customer base, if you think about it, right? So you've got Silicon Valley Bank. Okay, that's in California. Okay, who's their customer base? That's pretty much all of the startups there. Okay, so how do startups survive and thrive? Well, they get funding, yes, but in what form do they get funding? It's not from lending, it's from VC capital, right? So they don't get funding from the bank. So then Silicon Valley is like, yeah, we've got a bunch of customers here, but not that many, right? We're not servicing large corporations. So then we need to deploy this capital in some other ways. So what do you do if you're a bank? You buy the safest asset in the market. What's the safest asset in the markets? That's US treasuries, right? So long dated US treasuries, 10-year, usually you go for the 10-year because it's a round number, it's a good number. No, I'm joking, there is other reasons, but you go for the 10-year treasury, right? So then you buy the treasury, and basically, it sounds all good and well on paper, right? But then if you factor in the fact that the Fed was rising interest rates, well, then the equation changes a little bit. Why? Because bonds are not priced always the same. The price of bonds change, okay? So if interest rates go up, the price of bond goes down. If interest rates go down, the price of bonds go up. Because when you buy a bond, you buy a bond for, like, say 2%, right? At par. So you buy for 100. At expiry, they give you back the 100, right? If interest rates change to 20%, now your bond is probably valued at 80, right? Something along those lines, right? And vice versa, if interest rates go down, your bond value and your bond price goes up. So that when it expires at maturity, they give you back 100. This is to align the interest rates across the curve. right? Okay, so then what we know is that bonds decreased in value. So now Silicon Valley Bank has got an issue here because in the short term, before redemption, these bonds are trading at a discount, right? They're not trading at 100, which is when they bought them, or at least not the price that they bought them. Maybe they bought them at 98, 97, whatever it is, right? Now they're trading at a discount because the interest rate has gone up. So then as startups drain their capital because of, again, rising interest rates and therefore less liquidity in the markets, then they need to withdraw their capital from Silicon Valley Bank because they need to use it, they need to deploy it, right, in order to grow. Well, then there is a semi-run on the bank. Silicon Valley is saying, oh, damn, we don't have enough cash because we have deployed the cash, we have invested the cash in US treasuries. But now US treasuries have gone down. So, and in order to honor the withdrawals, I need to sell my positions. I need to sell my liquid assets, right? I need to sell my treasuries to honor the withdrawals. So then they start selling the assets, right? But they're selling at a loss because now they're trading at a discount, right? So they're selling at a loss, and then they give the deposits back to the first withdrawers, right? So the first people that knocked on the door and trying to get the money out, but then they don't have anything left for the others. And because the word spread across the street, right, on the street, and then everyone just went there and bank of their own, ran on the bank, and then they didn't have enough cash on hand. It was all locked up in these short-term treasuries and medium to long-term treasuries. Actually, if it's longer than a year, it's always long-term. So if they're all long-term treasuries, and yeah, so that's basically what happened. You shut down.
Okay. So poor risk management by Silicon Valley Bank. Does that mean there's less likelihood of contagion if it was a very specific error by one bank?
Yeah, look, the thing is, I've heard both sides of the argument here, right? So did Silicon Valley Bank put in place poor risk management practices, or did Silicon Valley Bank just listen to what Jay Powell was saying or to what the bank was saying? Because Jay Powell and the Fed were basically saying that this inflation thing was transitory. They did not say that they were going to they did not say that they were going to hike rates for 2 years straight, right? So then for them, it would have been a short-term issue. Something that you can mitigate with additional funding from the central bank, right? But in reality, that didn't happen. That prolonged over a few years, and we are where we are now. In terms of contagion, technically, as per policy, the FDIC only shows up to 250 grand, right? So if you deposit money with a bank or with eToro in certain countries, by the way, I know that in Australia it does apply. I think in Europe too. Your deposits, if you're not investing in crypto, because that's a different thing, or in CFDs, if you're investing in real stocks, in real assets, or ETFs made up of real stocks, right? Or when you copy people, it's the same thing. It depends on your country, right? But your deposits are insured up to 250K, right? Now, these startups, their monthly payroll is 250K, right? Especially in the US, like insane salaries, right? Insane. So maybe if you have like more than 10 employees, like your monthly payroll is already above 250K, right? So these startups used to have like millions in the bank account, right? And they were raising funding, etc. Right? Okay, well, so then the issue is, bloody hell, like if we only show up to 250K, right, which might work for retail individuals, players, right, it's not going to work for startups. So then there is 50,000 startups on the line here that are not going to be able to make payroll in a couple of months' time if we don't insure up to whatever they have, right? So the old startup ecosystem in the United States was at risk. So what did they do? They got together, Fed and FDIC, issued a statement late Sunday night, US time. We insure everything, like up to whatever you have, right? There's no contagion there. Then the thing is that most of those deposits, they haven't been lost, right? The people that managed to withdraw money, the companies that managed to withdraw money before they went bust, they just went to another bank. So then the question is, all of these other banks, the big four banks in the States, right? JP Morgan and such, right? US Bank, etc. Now they're gonna have massive inflows of money, because if you're banking with a small regional bank, do you really have the appetite and the risk appetite to leave your money there? So now a new trend will take place, which is to move funds from smaller entities into these large corporations. And I foresee that there is going to be some sort of concentration of the banking sector in the US and across the world.
Okay, that's very interesting. But we've got to keep things moving. So let's move over to the random question generation, shall we?
Yeah,
First
yeah,
question. First question is number 28. Describe your last holiday, Davide. This will be interesting because you happen to be in the Emerald Isle as we speak.
Yeah, look, I'm 32 years old. I don't have a partner just yet. I don't have family. Well, I don't have kids. I'm really trying to make the most of my last few years as a free man, which means that this translates into I travel a lot. So the last time I went to Paris. So now I reside I'm temporarily here in Ireland, right? But I do travel quite a bit. And I travel for work as well as leisure. And last time I was in Paris it was just a weekend. I just do weekends across Europe. Next, I'm going to South Korea. Then I'll be going to Amsterdam, Portugal, Spain. I'm doing all of the things that I couldn't afford to be doing when I was 18, up to actually, like until a few years ago, to be completely honest. Right.
Well, I hope you're getting to see some of Ireland while you're there.
Yeah, I do. Like it's not the easiest thing in the world to make quality friends as an adult, right? I can go out to the pub and make 10 acquaintances, right? But in reality, what you want is to have like a very high quality group of friends, right? That elevate each other, right? I don't need to spend time talking about the weather. I would much rather just stay by myself and watch some YouTube videos or read some books or listen to podcasts, right? Or focus on my personal growth rather than spending time talking about the weather. So I do prefer that approach, which means that I do not have a large social group.
And how's the weather?
It's not too shabby. It's actually better than I expected.
All right. Next question, number 30.
Ooh, 30. Nice.
How would you rate your performance over the last 6 months?
6 months. Well, the first quarter. So now we're finishing up the first quarter of 2023. It's been magical, right? We're 20% up so far. If history repeats itself, which obviously it's not, but if we were to stay consistent with this performance, it would be it would be 80%. If you factor in compounding, it would be around 100%. Is it going to happen? Nah, no way, right? There's no way that we're going to close at 100% this year. But, even if we close around 50, 60%, that's pretty good. It's going to recoup the losses from last year. But in terms of overall performance, I run the type of portfolio that has no time for underperforming the market, right? I believe that the next 10 years are bullish, and therefore I take on slightly more risk. I elevate my beta, which means that I'm a little bit riskier than the Nasdaq or the S&P 500, right? If you have that type of risk, there is no reason to go, to invest in anything that is not the S&P 500 or the Nasdaq, considering the last 10 years of performance. But I do take on more risk, which means that in down years, I'm down more. In bullish years like this year and 2021 and 2020 and 2019, I'm up way more than the Nasdaq. So do generate alpha by taking on more beta.
Next question is number 37. Is there anything you wouldn't invest in on moral grounds?
Moral grounds? Well, look, weapons. I don't like that. I can't really think of much else, honestly. I only invest in technology. I'll invest in solar, clean energy, technology, and crypto. If you look at my portfolio, that's what I specialize in. There's no need for me to go and look at other opportunities in other industries. I'm actually taking a liking on a new industry actually quite recently, and I'm gaining exposure on my private accounts because this is extremely risky, and I don't want my copies to be exposed to such a huge risk. But it's about genomics, so I'd be adding a little bit of genomics into the mix, and I'd be adding some India, but that's a whole different story. In terms of motor grants, I like if you look at my portfolio, you basically derive the answer to that question. I only invest in select industries.
Okay. Number 8. Any message you would like to send out to those copying you right now?
A big thank you, actually. Thank you for sticking with me throughout last year, which was a very difficult year. My copiers are probably the most sticky copiers because they understand what's going on, right? And I think I've done a decent job at communicating my strategy to them and making sure that we're all on the same page as to where we have come from, but also where we're going. And they're also some of the wealthiest, actually. So if you look at the average deposits, the average copy amount for my portfolio is much higher than many other portfolios, which goes to show that the investors and the copy traders that have elected and decided to invest in our portfolio have made a conscious decision, and these are like highly educated people in most instances, and they understand what I'm saying. They understand that the markets is not about day trading. They understand that drawing 2 lines on a screen is not going to give you an edge over the hedge funds. It's actually quite desperate. They understand that this is a long-term game. So they have set the stop loss accordingly, and now they're making the money back gradually. And I think they will be very well rewarded in the next few years.
Okay, great. One last question, maybe.
Oh yeah, go ahead. Go ahead.
And it's number 13. You were talking in such positive way there. I feel a bit bad to ask you this question because it's the most positive. But what's the one position in your portfolio you suspect might do the worst?
Oh, I mean, let's look it up, right? I mean, who knows? If it's in my portfolio, I think it's gonna do very well, right? Let's start from there. Even if it's down 20%, 30%, 40%, doesn't mean anything, right? The concept of you are not losing money until you sell. If anyone ever said that, they don't understand what they're saying, right? Because it literally makes no sense. It makes absolutely no sense. When you wake up in the morning, you should just assume that whatever you see in the bottom right, which is your balance, you should think, okay, if taxes were not an issue, because taxes do play a huge role there, but if taxes were not an issue, would I allocate my capital the same way that it's allocated now, right? So that's how a good investor approaches their positions. Just because, whether it's down 10% or up 20%, it doesn't matter. Would you allocate to this stock now in a world free of tax and a world free of commissions, right? That's it. So then if it's my portfolio, I'm not holding it because I think it'll maybe eventually I'll recoup my investment. Nah, that makes no sense, right? I'm holding it because I think it will do very well in the future. So if I really need to pick something here out of the lot that I don't think that is going to do as well as the others, right? Mm-hmm. You probably need to go down to the smaller allocations, because those are the smaller allocations with more potential upside or downside, right? So more risk. So then we've got Invitae, for example. That's a genomics company. If you look at the overall allocation that I have to that one, is less than 1%, right? So then that's the type of asset that you want in your portfolio for a very small percentage of your total equity, because it's a wild card, right? And I actually do believe Invitae will do well, but who knows? They're not even profitable, right? So this is the kind of answer that I would give you. Yeah.
Okay, Davide, we've crammed a lot into a short space of time. Thank you so much, and look forward to checking on your progress as we go through the year.
Yeah, let's do it, Gavin. Love the conversation, and thank you for making the time. I know that it's pretty late for you, so I appreciate you taking the time out of your busy calendar to meet with me.
Cheers, Davide.